My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you a little money. My job is not just to entertain you, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Welcome to the gauntlet, the 72-hour period where the bulk of the biggest companies report. It's pure mayhem out there. Even if the averages look sedate, Dow inching up 3 points, S&P declining 0.02%, NASDAQ tipping 0.34%. Stocks are flying all over the place. You got lots of operators who aren't investing. They aren't even trading. They're just gambling, and often gambling ends badly.
The House of Pain.
So let me give you my guide to the gauntlet, which, by the way, is also the name of a criminally underrated Clint Eastwood movie. The first thing you need to know is that playing this earnings game is much harder than it looks. Although people think, hey, I can just get in this, I can do this, I have a computer. Listen to me. Companies are not horses with CEOs as jockeys, and the enterprise is the horse. When you go to the track, you go to wager on winners. Now, unlike the ponies, there are lots of winners in this earnings season. In fact, we've got many more winners than losers, so you'd think it'd be easier than betting on a race. But that's not the case, though, because the winners tend to surprise you, while the losers just show up and no more. What defines a winner in this earnings period? Well, if we could do it with Google, wow, what a quarter. Take United Parcel, okay, with a stock that's vaulted more than 10% today. If you Google it, you'll see the stock that's up the most. Now, this was seemingly in response to an amazing set of numbers, right? That's what you think it was, right? That's what we heard all day. But that's not what drove up UPS at all. Sure, the gross margins were terrific. The pricing per package was unbelievably good. However, what you needed to know about UPS is that the new CEO, Carol Tomé, has repeatedly been dismissed on Wall Street as someone who wouldn't be able to tame the beast that is the unwieldy package delivery company with more than 400,000 employees. Now, it didn't matter that she's been on the board since 2003, so she knew what had gone wrong. It didn't matter that she was the dominant CFO of her time at Home Depot. Tomé came on our show after the last quarter, which was widely panned, right, and promised that from now on she'd beat all her targets. She said it was over. The missing was done. Well, that's exactly what she did. For many stocks, beating the numbers doesn't mean much. They'll do it all the time. Check out Procter & Gamble, Coca-Cola. Like, I beat the numbers. The numbers were better than expected. Stocks do nothing. In other words, UPS roared today because of the surprise factor. People betting against Carol Tomé. They were wrong. See, this is part of the reason why Alphabet soared tonight, too, when it reported an out-of-this-world top and bottom line beat based on surprises in two divisions people think are no good, YouTube and the endlessly underrated Google Cloud, which I keep telling you is good. But Microsoft got hit when it delivered a very good quarter that was better than expected, but not insanely better, because of the overrating of its cloud, which only grew at 50%, just matching the previous quarter. See, it's surprise. What matters is the game is harder than it looks, because of the surprise factor. Everyone knew that Microsoft would have excellent results, whereas lots of investors simply couldn't imagine Alphabet doing this well, even with its advertising business making an incredible comeback courtesy of the great reopening. In short, you want to look for situations where you believe the CEO, but you know lots of others don't. And you want to believe that key business lines will be sharply better than expected, but others don't believe so. Now, you know what? I think you got another one coming up. I think you got the setup exactly right when you're thinking about Apple tomorrow. See, Tim Cook's a chronically underestimated CEO with a mosaic of businesses, cell phones, wearables, computers, the service revenue stream, all under one roof. The secret sauce? For the last 20-odd years, Apple's been a consumer-oriented tech company, with a few notable exceptions. They've been shut out of the enterprise. Now, though, they've got it in. The rise of remote work is basically a Trojan horse for Apple, because so many senior executives use Apple machines at home. And for the last year, their home has been their office. You think I'm any different? Think I don't have Apple at home? But this is what you get, okay? Because this is the enterprise. You think I want Apple here? Yeah, but you see, it's the enterprise. Oddly, I suspect Facebook's got a similar situation. They're obviously not good. They're Apple's polar opposite when it comes to privacy. When Apple decided to allow its users to opt out of tracking, Facebook slammed them for hurting small business. Yeah. Bar San Miguel's tracking everybody in the world. While I like Facebook and genuinely appreciate what they've done for small business, that argument's totally disingenuous. Small business doesn't track our online behavior, for heaven's sake. But the endless fouls called against Facebook gives you an opportunity to buy the stock at a discount as long as Facebook doesn't cite Apple's policy as a reason to cut a forecast. I'm betting they won't, although when it comes to Facebook, anything's possible. Now, there's another type of earnings winner. You need a situation where stock is cheap versus its cohort, and can therefore play catch-up. And that's what happened with Wells Fargo and Goldman Sachs. The former underestimated because of past transgressions, the latter because its earnings were viewed as too episodic. Both exploded higher when they delivered earnings that were on a different plane from the past. I still like Wells Fargo here because it's incredibly cheap, trading at 1.1 times its book value, which is what you get if you liquidate the whole business tomorrow, though you're not going to liquidate it. Who else fits the bill? I got one for you. I think the next one could be Ford Motor Company. They report tomorrow for the close. I know the chip shortage is hurting them. So do you. So does everybody. I mean, is there a person? Do you know? Yeah, you know. Right? Everybody knows. But what matters is that the company decided to stop selling cars in areas where it can't make money. That means shareholders can finally enjoy Ford's great American profits without seeing them wiped out by Europe or South America. It's a wholesale change in the way they do business. They're actually committed to making money. Strange? No. Stock sells for nearly 10 times earnings. Sometimes the best way to learn from the gauntlet is to look at what failed to rally. So now we're going to consider Tesla and Netflix. For once, Tesla didn't come into the quarter with heightened expectations. That seemed good, right? In fact, it was the most subdued I can recall, especially with the stock down almost 200 points from its high, which was out right after it was added to the S&P 500. The company delivered terrific sales, maybe a little bit constrained by the semiconductor shortage. Just so far, so good. But Tesla's bottom line, it seemed confused. It was confused, okay? Get this. When you subtract a brilliant sale of Bitcoin to rack up $100 million and you adjust for credits along with stock-based compensation, well, what happens? You get almost nothing. That's not what the bulls were looking for. We come to expect sales and earnings from Tesla, but we only got the former. When you get people hooked on perfection, Elon, anything less than that will send your stock lower. How about Netflix? Or here's a company where the expectations tend to be too high, but this time because they got such a huge pandemic, a huge boost from the huge pandemic. Will you focus for a second, Cramer? When they got such a huge boost from the pandemic last year, the estimates were sky high. Just one problem. Their subscriber numbers came in much weaker than expected, with management blaming the dreaded pull-through. Oh, that's a term. That term is cost trillions. Pull-through, meaning last year's big sign-ups basically cannibalized this year. The takeaway, when you're dealing with a company that's benefited from the pandemic, make sure it's still benefiting from the pandemic now that it's over, instead of going back to where it used to be. We own Amazon for my charitable trust, but if management uses the dreaded term pull-through, then you have a Katie bar-the-door situation. And I'm hoping that's not the case. Now, perhaps you don't want to play this game. Well, amen. Maybe you'd rather invest than Wall Street bet on earnings reports, which is a much better idea. In that case, you want to look for stocks that the market misjudged, either the rearview mirror work here, either the ones that got slammed because people incorrectly came to the conclusion that they did badly, or the ones that simply didn't get enough credit. The former? Okay, well, that's Honeywell or Union Pacific. Honeywell still stalled, but it's now mounting a comeback. Union Pacific, remember I told you about it the other day, it's already made it back from ridiculous quarterly sell-off because its prospects are so good. The latter group, the ones that didn't get enough credit, that's Raytheon with the defense business that turns out to be our best hope of countering China, especially if they do something crazy like try to take Taiwan. And I like AT&T too, which reported a great quarter and took risk off its dividend. More on them later. The bottom line, if you're trying to rent stocks for the earnings report derby, now you know what makes for a potential winner. This is your rules, okay? Just write them down or take a picture of it. Or like watch it on the video. I don't care, but at least get it, put it in your head. But honestly, it's far easier to invest in wrongfully convicted stocks that get knocked down because Wall Street misjudged the results. The gauntlet just throws up a lot of buying opportunities. But you got to know what to look for, and you got to use the checklist.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.